Mr. Kamath, it's a pleasure to have you here with us, and thank you for taking the time out for CNBC TV18. Sir, to begin with, the RBI has, unveiled sweeping regulatory changes, whether that is capital market financing, easier lending norms for, IPO financing, corporates, scrapping or rather deferring the ECL timeline significantly. What does this mean for the playing field for banks, whether that is the risk appetite, capital allocation, or even credit growth?
Thank you for having me. I look at it on a very broad frame, as it were. If I look at a few years back, what a bank could do and where we were at this point in time, for a variety of reasons, banks which were primarily in corporate lending, working capital and corporate loans, and also infrastructure credit. So one side of the book, more than 50% was these type of assets. The other side was retail assets. That has flipped, and particularly post-COVID, that has flipped in a very hard way, where you now have a majority of the assets retail, and then you have corporate. To me, what it meant was that banks were missing out on opportunities in an economy which is growing around, let me round out the number, at 7%. So in a 7% economy, the key driver is going to be your corporate side of the economy. And the banks were somehow getting left out of that sector for a variety of reasons, some of which have been now tried. There are other reasons which are more structural. For example, there's greater access to capital markets now, which till 5-7 years back, the pension industry, the long-term savings industry, the insurance industry, the MF industry was still growing. But now it's growing at a pace. So good corporates, large corporates can access that market directly. And so the banks, in a way where you could see in their capital adequacy was very flush, as it were. So I think this opens up equal opportunity in a way for banks. And to me, it is excellent news.
But, in terms of signaling from RBI, do you think this is a very different regulator than what we had a few years ago? And, is the signal that this is a more growth-friendly regulation, or as some in the industry have expressed concerns, some of the dilution of prudential, guardrails as well?
No, I don't agree with that second proposition upfront. In my 55 years in business, I have not seen the RBI, not taking its eye off the ball. They're never ever. They are always very focused. So that is not an issue. In terms of various regulators, regulatory heads doing various things over a period of time. Again, when I look at things over time, and particularly from '96, when I was in a, I'd say, position where I could take a better look, regulation has always followed what is possible given the environment. So we must remember, sometimes we don't put it into context. We hit $500 billion as a GDP only in 2004. So the regulations that were appropriate for that period of time were in place during that point of time. That is, as we headed from $250 billion to $500 billion, and I think it took us 20 or 25 years. Regulations were appropriate. And we might have had views on that, but they were appropriate. And then growth momentum started. And we could see easing happening. So I would think that at each point in time, every 5 years, let us say, in RBI, I have seen an evolution in terms of how they look at, what they need to do in the context of the overall economy, in a policy construct and a supervisory construct. So I think what they have done is appropriate, considering where we are at this moment.
Sir, M&E financing, how significant is it allowing banks to finance acquisitions? Because, what has really changed from RBI earlier not wanting to allow banks to do it to now, changing its stance on the matter?
We actually have to go back to answer this question many decades.
Yeah.
And, some of us, I think, are too young to have understood why this was not done. So there was a period of time when we thought acquisition by one company of another company typically is a hostile route. And that the bank should not be an instrument in doing this. So this was long back. So I think that has now been set right in current context where everything is a market. and everything goes through the marketplace.
Yeah.
And in any case, if acquisition financing has to be done, there are other people providing private credit to do this.
Credit
Or
is doing it.
you go through the capital market route and do this. So I would think, looking at the risks at that point in time, the way business was being done at that point in time, that was something that was not allowed. And now, in a completely different context, I believe the Reserve Bank has done the right thing to open it up, because it's an excellent avenue of business for banks.
Yeah, how much credit do you think all of these measures put together could really unlock? And more importantly, while this is an enabler for banks to lend more, is there real demand on the ground from corporates, given the deleveraging cycle we've seen and the global uncertainties?
There are two different things here.
Yeah.
Deleveraging, I think, is now a mindset issue with the Indian corporate.
Yeah.
They will not leverage themselves, by and large, the larger companies. I think at the MSME end, that will happen in due course. But we are talking of the mid to large corporates.
Yeah.
So it's not a question of deleveraging. This was for business purpose and acquisition.
Yeah.
And in most cases, these acquisitions are in a friendly mode.
Not hostile takeover.
So now you need to, it's not hostile, but you need to understand whether there are risks. What are the securities? What is the underlying value of those securities? All those, that analytical skill is required, and I'm sure banks will come up to speed on that. Now, your question was, is there demand?
Yeah.
I'll say this, I'll not put a number to it, but every single, I would say, global entity that I talk to, of whatever type, if they are in the financial services business, so I'm not naming it is a bank, non-bank, investment bank, I'm saying every single entity in the financial services business globally were looking at India as a great place to come and set up a private credit business.
Okay.
Bringing in external funding and then providing this credit which Indian banks were not allowed to do for the marketplace. So the curiosity that was there, the interest that was there, and the opportunity that they saw, to me means that it was a very large number that is being talked about.
That is on the corporate side, sir, but with the government's GST rationalization, to what extent do you think could there be a growth delta add from these cuts alone, especially when it comes to retail credit demand?
Yeah. So for the retail side of it, if I were a banker, what would I look at it? I have two businesses. One is my corporate customers who produce things for the retail industry, and my retail industry. At any point in time, what you need to look at, I would think, are three numbers. What is the overall growth in the economy? And I say I round it off to 7%. It's a very healthy growth, which should have a multiplier effect of, say, 1.5 to 1.75 times. So we should see credit growth growing at maybe 11-12% without any problem. So that has to be facilitated for the system, combining both corporate and retail. Within that, the retail side, let us assume, was hitting a bit of or facing some sluggishness. The GST cut elevates that sluggishness. You're now able to breathe better. The retail customer is able to buy what the customer aspired for, and then going forward. So that is happening. However, having said that, I think on the retail side, there is need for caution. I think there is need for caution in a whole range of products, particularly unsecured products in nature. If you look at unsecured products, and you need to be very clear that these are not consumption spend which you cannot really afford to service. That is dangerous. I'm not saying that that is visible, but that is dangerous. Some stress has been seen in some areas, but I'm sure between the regulators and the concerned companies and concerned businesses, they'll take care of it. But overall, good for business.
You have flagged this over-leveraging retail credit before as well, especially, I think you spoke about fintechs lending to people with not such good credit scores, often with multiple open credit lines. Are there some kind of guardrails that banks must preemptively put in place, apart from the risk weights being raised, to ensure that there is no bubble?
See, you put it very nicely to say multiple credit lines. For a banker, that is taken as, evergreening. So you use one credit line to green another one, and you take another one to green the earlier one, and so on. I think by and large, this about 3 years back, the Reserve Bank took steps, increasing risk weightages and things like that to curb that. So, and you're seeing that in the overall credit quality of the banking portfolio, where NPAs are at level and sustained to be at levels which I have not seen in my career. So less than 0.5% for most large entities. To me, the riskier side is very clear to identify, and one could look at it deeper to see to what extent there is a risk. But risk surfaces when NIMs go too high. So NIMs go too high for one of two reasons, either greed or provisioning. So we need to see what is really driving us, because a high NIM would also mean that the customer has to bear that burden of interest, which he or she is not able to bear.
Well, that is the retail side of it, but, just picking up a theme on, again, something that you'd spoken about earlier, banking system in the last 10, 20, or even the 50 odd years that you've seen it has changed dramatically. It is nothing like it was before. It's more of a digital platform, and the competition is not just from fintechs, it is from every company that has tech. You see the scramble for deposits, for instance, something that banks have been struggling with. Do you think the traditional banking model itself needs a bit of a rethink and overhaul?
That will evolve over time. However, what needs overall is the technology platforms that the entire financial system is using around the world, not just India, because these are all legacies. In most cases, the core platforms, the engines, are at least 30 to 40 years old. And then you have modern players using players who came up in the last 4 or 5 years using modern systems. Now, this competition is unequal. So the incumbents and the legacy who are using legacy platforms need to think, how do I get to the current state? It's not as easy as I'm making out to, but their ability to traverse this journey will mean whether they come under competition or not. If they traverse it, there is no competition. They will. They are the big boys. They have got the muscle, so they will be able to hold their territory.
But are the big boys investing enough in technology to your mind?
It's not investing enough or not. They are investing a lot more than they ought to, but they're not investing it right. I'll make this very clear. Technology investments by big players in the fintechs around the world, in the financial services industry, not fintechs, around the world, they're not investing what they ought to invest. They're investing much more than what they ought to invest, but in things which will not take them anywhere.
So
they are basically taking forward legacies. You need to make a complete break from legacies and move to platforms which are current. That's not happening.
Okay, that is something to take note of, sir. Just to step back and look at the broader economy, you said we're a 7% growing economy. RBI has a 6.8% kind of a number. We remain the fastest growing.
I never quarrel with what the policymakers have put out. So as I get slightly older, I round off, so that's easy for everybody to keep in their mind.
But what is the sustainability of this 6.8, 7% kind of a growth with the global turmoil that we're seeing?
To me, in a way, we are a microcosm. We need to keep track of what's happening around the world, but we are a microcosm. Why do I say that? I think I've seen transformations happening over, say, if I look at 50 years. And you start with Japan, the 70s. 70 to 90, 92 was there. China, 2000 to, or late 1990s to 2015, 16 was the heyday where they had double-digit growth and so on. One thing is very clear, that transformation journey is a long journey. And once it starts, it's very difficult to put a spanner or throw a spanner in the works. So it goes on. Yeah, there are these global things that are happening around you, but as long as you manage your economy in a prudent manner and are focused. And I must say that whether it's our government, whether it's our regulators, everybody is clearly focused on doing the right thing by India. So that keeps your growth engine going on. So I'm a firm believer that Viksit Bharat is something out there that will happen. And the journey is to 2047. And that journey, you take it at 7% plus, I think will get us to a stage where we are a developed country.
Capital markets are on fire. I think we've had 78 IPOs this year, $14 billion and much more in the pipeline, if that tells you a story.
But I'm looking at not only that, I'm looking at the debt market also.
Debt market also is maturing, Well, on that note, Mr. Kamath, it's been such a pleasure speaking with you. We'd like to continue this conversation. Unfortunately, we've run out of time. But thank you so much. Thank you for gracing us with your presence.